when you take a look at traders' bets on the markets at the moment, what's that telling us about expectations for the Fed?
Absolutely. And the risks for bond traders, it's important to remember, go well beyond whether the Fed will raise interest rates again this week. Now, remember that investors have been relentlessly betting that the Fed will be forced to cut rates later this year if the US economy enters a recession. But those bets, when you have a look at them now, have actually pulled significantly from, say, a month ago, as inflation, it comes back down to inflation remaining stubbornly high. And some officials say we still need to hike to tame this beast. So right now, where are we? Traders remain split over whether a rate hike is likelier in June or July. All eyes will be on Jerome Powell, and importantly, the press conference after the decision for traders to really recalibrate their responses on what the Fed's next move will be.
And positioning in the Treasury space?
Yeah, look, we've seen Treasury yields really jump higher in the past week, and that's actually in part thanks to the shock interest rate increases that we saw from Australia through to Canada. The message, though, from central banks is clear. The fight against inflation is far from over, and that means bad news for bond investors. That said, though, investors, some of them are seeing the sell-off as an opportunity to buy. So at around 3.8%, where we are at the moment for the 10-year Treasury yield, investors from JP Morgan through to Aberdeen have previously flagged that these levels are actually pretty good to get into. Family offices that I've spoken to in Singapore have said that they're actively adding duration as well to take advantage of higher yields. So it really does depend on where you sit on the curve.